Hello, my name's Brian Tillotson, and I'm founding partner and wealth advisor at Virtus Wealth Management. Thank you for joining us today. We're going to have a short video on inflation since it's a hot topic right now. Before I go further, let me introduce Preston Tillotson, who's going to moderate this for us. And then before we jump in, let me just kind of give a little background to this because the reason this is a hot topic is March and April, we did see a jump up in pretty good increase in the CPI numbers, which were both surprising. And so, 1 month is maybe an anomaly. You start getting two, and then it starts becoming a concern. So with that, let's go ahead and kind of jump into the discussion.
What is the debate regarding inflation?
The big debate right now is how much of this that we're seeing is transitory and how much of it is going to be longer term lasting. And let me just kind of go over the transitory first. And when you're talking about transitory, there's quite a few reasons we've seen the increase that we've seen in inflation that might not be something that we should worry about long term. For example, travel. Just a small piece, but travel. There was a lot of pent up demand last year because we really couldn't travel much, if at all. And then now we can, and so people are like, okay, I got to get out and I want to travel. And so we're seeing that, and that should work itself out over time, and even out. We also saw some issues with the where people were spending their stimulus checks. And when I say issues, it's not issue where they spend it. It's just there wasn't service like products to spend it on, or areas. People. It was hard to go to sporting events and travel like we just talked about, those type of things. So people spend them on hard products, which leads us into the biggest reason that many believe this is transitory. It's just the supply and demand imbalance that we see sometimes coming out of a recession. So understand, when you're going into a recession, companies pull back on what they're producing. They don't want a bunch of inventory. They think the demand is going to dry up, so they produce less in anticipation of how deep the recession is going to be. And with COVID, the expectation was that the recession was going to be much worse than it actually was. And there was actually a quick turnaround. And so that real quick turnaround, plus, like I said, with the stimulus checks being spent and everything on hard products, you ran into a situation where there was just a strong supply and demand imbalance, and that has to work itself out. And like I said, that doesn't necessarily mean that's going to be long term.
What is the other side of the debate?
The other side is this isn't transitory, and this is going to be a long-term issue. And this is typically due to the belief that, it's just basic economics, right? If the government is increasing the money supply, then, and which many people call printing money, then it puts more cash into the economy, and now you have more cash chasing the same amount of goods, so prices go up. Right, and so we kind of saw a little bit of a double whammy because you increased and then the money supply, but you sell less goods because of the supply and demand imbalances, and so you're kind of seeing the worst of both cases there. Many people that believe this side of it will talk about in the history going back. For example, we saw a 29% increase in the deficit last year in the money supply, and then that you got to go back to 1943 since the time before that we've had that big of an increase. And in 1947 we saw a 17% increase in inflation that year. So they're looking and saying, look, here's what happened before, and so here's what could happen again today.
Where do you stand on the debate?
My belief is, as I said, starting off, we need to be concerned, but I think it's way too early to panic and start making wholesale changes to the portfolios and everything like that. We need to let some things play out to see how this all works. I'm not a big fan of comparing this to the 1940s because there's some major differences. And for example, they had price caps on products in the 1940s coming out of the war, and they took those all off in 1947. So sure, people raise prices a lot then, so not overly surprising. The other is technology advances. They have to be accounted for because the best way to curtail inflation is to have major production increases due to technology. They reduce cost. And so I don't see why that would change going forward. Not only that, we saw some of this sped up significantly by the COVID. I mean, for example, Zoom meetings. Companies don't have to travel as much because they figured out, hey, we could have Zoom meetings and do this and without the travel and everything. The movement to work from home had a big jump start last year. And if that continues, and I don't see any reason why it shouldn't, you're going to have less rent. You have robotics, artificial intelligence, cloud networking. All these things are huge in lowering costs for companies, and if that continues, that we should benefit from that on less inflation. So for me, I think tying this back to the 1940s and everything is looking at it at the 10,000 foot level and missing the details. But we should be concerned, and it's something we need to watch and not ignore. I'm not saying ignore it at all.
What specifically will you be watching?
Another good question, because I think that's really what's important. I'll say what we're saying is, okay, be concerned. Let's wait and let it play out. Let's be patient. Let's don't overreact. But let's be diligent about it. And to be diligent, we need to watch. What I'm watching is three different areas. One is wage inflation. We have seen a little pickup in that, but how much of that is due to the unemployment benefits that have kept people from working because they didn't have to, which made that a more of a buyer's market for the employees. Now, all these people coming back into the workforce might help the wage inflation not increase like we've seen. The other is the imbalances we talked about. I think most of these imbalances are going to start working themselves out in the third and fourth quarter, except for the semiconductor imbalance. That's probably going to take the first part of next year before we see that. But if we start seeing that these imbalances aren't working out, then we've really got to refocus on that. And then the final piece that has me the most concerned is the Fed. The Fed is in a tough spot right now. It's not an easy thing to do. If they keep rates low too much longer, they're just going to cause this issue to maybe even explode, right? We can't keep throwing money into this and making it very easy on the money supply here for this, because that's going to increase inflation. But at on the flip side, they have a issue with raising rates too early causes problems with debt servicing costs for the U.S. deficit, as well as maybe impacting businesses at the wrong time. So there's a balance. So I'm watching how long it takes before the Fed starts increasing rates, along with wage inflation and these imbalances. So that's kind of what I'm watching.
What should investors do if they're still concerned about inflation?
That kind of boils down, because we get calls on this, and being people want to go to cash or whatever else. If your main concern is inflation, right, and that's what we're talking about here, going to cash is probably one of the worst things you can do, right? You're sitting there earning nothing while prices are going up. It's the very definition of losing pricing power. So there's always winners and losers, and when the economy makes changes like this. So there are other things we can do to offset the impact of inflation on a portfolio. If you have questions about that, give me a call, 817-717-3812, and or anybody in my office, and we can talk through about, okay, here's the different options, different strategies, and see which one of these fits you the best. But again, let's not overreact to the hot news for the day. Let's wait and see a little bit how this plays out. With that, I want to thank you for joining us, and like I said, give me a call if you have any questions. Thank you.